All right. Hello, everyone. My name is Chris Wade, Partnership Manager, Account Executive here at Bitwave. And today I have the pleasure of speaking with Patrick Camuso CPA. Patrick, how are you today?
I'm doing great, Chris. Thanks for having me.
Excellent, excellent. And for those who don't know, could you provide just a brief introduction about your specialty and your firm?
Absolutely. I'm the managing director of Camuso CPA. We work with clients nationwide. We work with both Web3 businesses and individual investors on helping them establish accounting systems, manage those accounting systems on an ongoing basis. And we also assist them on the tax side of things as well when it comes to tax preparation and tax planning. And my firm has been doing that since 2016.
Wonderful. Excellent, excellent. So for today's conversation, we're going to be talking about tax, about the upcoming IRS revenue procedure 2024-28 that is scheduled to be implemented at the beginning of next year, January 1st, 2025. So I was wondering if you would be so kind to provide some insights in terms of the upcoming regulatory requirements.
Absolutely. Firstly, Chris, I'm really glad that we are doing this video today because I think this is one of the biggest tax and accounting changes that we've seen for cryptocurrency since its inception and since the IRS has started releasing guidance going back to 2014. So, what this revenue procedure is doing is really trying to accomplish two things from a tax standpoint. The first one is to eliminate potential compliance issues and matching issues with third-party reporting. So this revenue procedure got released very close in time to when we saw the broker regs get finalized back in June. Now, obviously, the broker regs, we're going to start to see reporting on that come out in 2025. I think we've done separate videos on that in the past, so I encourage people to check those out. But there's going to be third-party reporting coming from exchanges and other brokers starting in 2025. That is all going to obviously be done on an account basis because each exchange is going to be reporting their respective transactions. So, that's really like the first point of this revenue procedure is taking this universal calculation and shifting you to an account-based calculation. So you're going to have more congruency with this third-party reporting. The second big issue that this revenue procedure is addressing is the fact that industry-wide, we've seen many companies and taxpayers and even firms incorrectly apply accounting methods on this universal basis. Oftentimes, they're selecting HIFO or other more aggressive accounting methods that lead to better tax outcomes. But under the universal method, a lot of times, the audit trails that get created for, under HIFO are not going to be reflective of the flow of funds on chain. Meaning, you may be selling Ethereum on Coinbase, and the highest cost that gets assigned to that sale may be from Binance. And that can get automatically assigned to that sale under a universal basis, even if a transfer never took place. So, this can lead to somewhat abusive practices from an IRS standpoint related to, the overall taxes being calculated on any given sale. So what this revenue procedure is going to do is require the account-based reporting, and then it's also going to require standing orders to be left with brokers and documented in non-custodial wallets. So you're going to have this congruency with your reporting, and you're going to have to choose a tax lot that you're selling following certain methodologies at the time of sale or before the time of sale.
Right. Incredible. Incredible. Now, when companies want to clearly, follow guidance, what are some best practices, or what are some ways that businesses can really prepare between, the end of October and January to make sure that they follow the necessary guidelines set forth?
Well, I think you made a good point because we only have a couple months at this point. It's coming down to a matter of weeks almost rather than months, especially when we start to consider all the holidays and, this time of year that's coming up. So it's
Right.
imperative that if companies have not already started working towards compliance with this, that it becomes one of their top priorities because there can be negative tax implications if you don't comply with it. What should they be doing? Number one is ensuring the accuracy of their accounting. One thing I'll say is like when we're taking on a new potential client, one of the first things that we have to do if they've already have done some previous accounting is scrutinize the accuracy of it and ensure that there was proper due diligence done on the accounting. One thing that goes overlooked quite frequently are the ending balances, the calculated ending balances compared to what's actually being held by a company on chain and across exchanges. A lot of times when I'm trying to onboard a new client, I'll see inconsistencies between what, they've calculated and what has been what is actually on chain. If we're going to properly do these allocations, we're going to have a cutoff to where you've accurately calculated your cost basis to even start the allocation process. So, I'm worried for companies that maybe have not prioritized their accounting in the past, and now they're looking at getting themselves caught up to even be in a position to start to do these allocations.
Right, certainly. Now, it seems like there is an opportunity to reallocate cost basis between now and January 1st. And then from there, perhaps would you recommend certainly a hard close for 2024 and then implement that new per wallet inventory methodology moving forward into 2025?
Yeah, I think there's really no choice. They're going to have to do
Yeah.
that. And right now with our current clients at Camuso CPA, that's exactly what we're doing. It's just, keeping the books up to date as closely as possible in anticipation of, making these allocations in a timely manner. So the allocations themselves, the date set for that is January 1st. At the
Okay.
very least, you're going to need to be documenting your standing orders and documenting the allocation methodology that you're using by January 1st. Depending on the allocation method you use, you may get a little more leeway with the timing of that. But yeah, it's imperative to keep the books up to date so you're in a position to, comply within this deadline.
Interesting. Interesting. So I'm with the reallocation of cost basis. Does that have to be done before January 1st?
In certain scenarios, yes. So there's
Okay.
two main allocation methods. One is the universal method. It may be referred to as something different in the regs. It's the universal method, and then there's the specific allocation method. I believe most people are going to be using the universal allocation method in
Yeah.
most cases. And with that method, the hard deadline for January 1st is basically two things: the standing orders and then documenting the
Yeah.
allocation method. And it's not called the universal allocation, it's called the global allocation. It just came to me now. So under that method, you need to document how you're going to do the allocations, and you need to document the standing orders. The allocations themselves, if it does go past January 1st, the hard deadline is the earlier of when you file your tax return or when you first transact in that given asset. So, if you don't do like your allocation for Ethereum by January 1st and then you transact in that on January 2nd, you're now not in compliance. But, if you wait a week and you do the allocations and then you transact in that asset, it can buy you a little bit more time.
All right. Yeah. So as long as there's no disposals uh,
Yes,
happening, then it's just like, all right, well, week 1 of January, I'll be able to move some uh,
exactly. Exactly.
funds. And it's interesting if you're moving cost basis. You're if it's a wall-to-wall transfer, there is no tax impact in that regard.
Yes. Yes.
Um, yeah, good questions there. I really appreciate the feedback there. Now, what are some indicators that a business should take into consideration that they should reallocate cost basis? One top of mind is that they don't have any wallet hygiene, wallets that have maybe multiple purposes. It's just like now it is a good opportunity to speak with the CPA, take a look at your the type of transactions that are occurring. What are these wallets used for? And then develop a strategy between now and January 1st.
Yeah, you definitely need going forward, you're going to need to have good wallet hygiene. It's not uncommon if you're working with a new Web3 startup, they sometimes forget about having wallets, or wallets are commingling funds together for different purposes, or sometimes even between different entities or between personal funds. So, all that's going to have to get corrected going forward. there's, moving forward with this revenue procedure, it's requiring much more sophistication, not only in your accounting process, but to how you're managing funds on chain. So you're going to have to clearly, delineate every wallet that you own, what you're using it for, and then accurately account for the assets that are held within it. And I do think that's going to be challenging for a lot of companies that have overlooked their accounting up to this point.
Yeah, I would imagine that companies are going to need to implement more role-based accounting controls.
Yes.
If there was just one wallet that was used for everything that someone had access to, and with the prior universal strategy, they're still disposing of these tax lots in a long-term treasury holding. Now, the
Yep.
only way to dispose of those assets, let's just say you bought certain assets you want to dispose of back in 2016, you actually have to have access to that wallet connected on chain and dispose of them, and then run FIFO
Absolutely.
out of that
Yeah, and I
specific
think
wallet.
this brings center stage the accounting function. A
Yeah,
strong crypto CPA and a strong subledger solution like Bitwave are table stakes now for a Web3 company, because not only does your accounting have to be accurate to comply with this, but when you're just dealing with your day-to-day business activities, like you said, maybe paying funds out of an account. Like, are you going to pay someone out of wallet A, wallet B, or wallet C if you're paying them with Ethereum? That can have significantly different tax implications
right.
under this new reporting regime. So the accounting is something that has to be done correctly and done in a timely manner. So, people that are moving funds and managing the business are able to make these decisions in real time. Whereas before, under the universal method, you kind of could just spend and give it to your accountant later and let them deal with the historical mess. But now it's going to be much more beneficial from a tax and business standpoint to have this information in front of you in real time.
Right, absolutely. You want complete visibility in the cost basis in tax lots for every single wallet. And then from there, as long as you know what you're working with and putting some best practices in place, you can manage and then
Yeah.
develop strategy to
Yeah,
maximize
I
profits
believe
or
I
reduce
believe,
tax liability.
everyone wants to talk about getting more, clarity from a regulatory standpoint. Obviously, this is going to create more of an administrative burden to a degree, but I think this does give more clarity because, my firm has been doing this since 2016, and for years I've been warning people about using HIFO and other accounting methods like this under a universal basis, because it leads to audit trails that, don't match the on-chain flow of funds, probably isn't going to lead to a good outcome
Right.
for
Yeah.
taxpayers. So now that we have this clarity, that we're going to have, steps that we need to take to leave standing orders and these account-based rules, it does, once you deal with that initial burden of complying with it, it does open up tax planning opportunities to, set more advantageous accounting methods and monitor your flow of funds and sometimes get better tax outcomes as a result.
Right. Yep. Yep. Now, I'd love to hear your thoughts about specific identification. It seems like the majority of businesses utilize FIFO. That's more common. I've been hearing HIFO, but there's some specific requirements that pertain to Spec ID that I'd love to hear your thoughts on. And what type of businesses do you see that opt for Spec ID? It's interesting to think about gap and then also tax.
Yeah. So, historically speaking, I would say, or overall for cryptocurrency, there's really, like, technically speaking, two acceptable methods. One is FIFO and one is Spec ID. And, when you've seen people selecting HIFO, LIFO, or, any of these other methods, it's really under the pretense that Spec ID is an acceptable method with the IRS. And that goes back to the Q&A, I think 39 and 41 that the IRS released years ago. So in the past, to a degree, people have been misinterpreting that because, they haven't been able to specifically identify which assets they're selling, at that point of sale or beforehand. But I do think that this now is going to become more viable for companies in the future because the IRS is giving us a roadmap to how we can actually apply specific identification. So, you're definitely going to have to leverage a robust accounting system for this. And I know we were discussing this a little bit before the video, because you are going to have to be able to identify those tax lots in real time. You're going to have an accounting system that is, building out a mechanism for that. And then you're
Right.
going to have to select which tax lots are going to be deemed as sold when you're doing it. You're not going to be able to bring this to your CPA a year from now and then choose what's being sold. So spec ID can be extremely valuable for companies that are holding assets with varying cost basis in them, especially if you're able to separate those lots out using something like Bitwave. It can lead to very good tax outcomes.
Absolutely. Yeah, I'm excited about the revenue procedure 2024-28.
It's a mouthful.
And I'm also just the mindset too. Like one thing that just comes to mind, it's like, all right, you know what? I have a bill that I need to pay. I'm going to double check the invoice that I received. All right, it's X amount. This is the date when it's due. It's 9/30. There's a lot of checks and balances and due diligence that's a part of the AP process. And it's having that mindset with disposing of your digital assets. It's just like, all right, I know I need to dispose of this asset on this specific date. All right, I haven't done it yet. Let's take a look at my inventory within my wallets. All right, here's tax lot A, B, and C. All right, here's the cost basis. Here's the current exchange rate, so I can estimate a certain tax impact as well and be able to pick that lot appropriately. All right, everything's good. Dispose of the asset, make the payment, and then have that properly accounted for within our inventory. So that way, when we need to produce the necessary tax filings at end of year, end of quarter, whenever they're due, you'll be able to follow the guidelines accordingly.
Absolutely. I think it's a great opportunity that there's now, these features getting built into subledgers like Bitwave, because it's going to give people the opportunity now to use spec ID in a compliant manner and optimize their taxes. But it all really goes back to the fact that people are going to have to stay on top of their accounting. They're going to have to utilize a sophisticated accounting system that they manage on an ongoing basis to be able to even be in a position to make these types of decisions.
Yeah, it's really remarkable in terms of choosing either FIFO or spec ID and the implications that you have on your financials from an accounting perspective, and then also tax, and then with compliance. So we're covered our bases. Really appreciate the insights here. One last quick question. Can any business choose spec ID taken into consideration with GAAP?
For tax purposes, I don't see why they couldn't choose spec ID. It may differ from their GAAP accounting though.
Okay, all right, yeah, that's something for us to look into. But certainly for tax spec ID, or FIFO, as long as you have per wallet level inventory or account, as you said earlier.
Yes, and I also believe if you're leaving standing orders, you can leave standing orders using HIFO or other methods, as long as you're using some identifier. So in that case, you can use the dates as an identifier.
Right, with the standing orders that you set in place.
Yes.
Prior to I want to say for the full tax year, correct?
Yes.
All right.
And those standing orders have to be put in place prior to January 1st. Is the big thing.
And would someone let's just say they put the standing orders, and after a full year, they might want to make some changes. They'll be able to do that for the following year.
That isn't, while I'm saying here right now, I don't quite frankly know the answer to that. I don't think it was really discussed in the revenue procedure. What my instincts tell me is likely you're going to have to stick with what you choose, so you have consistency year over year. We're not going to want to see FIFO one year and HIFO another year. But if you're going under spec ID, you're still going to retain that flexibility if you use that method, because then it's really at your discretion still.
Right. Yeah. And correct me if I'm wrong, but you can choose spec ID. But if you follow outside the guidelines of spec ID, it defaults back to FIFO, correct?
Yeah. If you fall outside of any of these guidelines, even if you're going to want to use HIFO and you don't leave your standing orders and you don't document them in your wallets, or maybe you forgot a wallet that you owned for years and you didn't document it in that one, you're defaulted to FIFO. So it's very important to leave the standing orders.
Incredible. Well, Patrick, again, I'm excited. I'm looking at this as a big opportunity. It's great to allocate some time to share this important information to our community. Is there anything else that you think we should discuss?
Yeah, what I would say is, to the builders out there, the Web3 CEOs, if this is the first time you're hearing about this, you don't have much time to get this in order. And it is extremely important to your business. It's high time to start, adding this sophistication to your accounting process and to your back office. There's no more time to wait. Basically, that this revenue procedure really is an imperative on the whole industry. And to the CFOs and the tax professionals that are out there watching, I think this topic is going widely overlooked. I think companies that fail to comply with it are facing, increased audit risk, and it's really an opportunity for you to be proactive in advising them, reaching out to them, and explaining this revenue procedure to them and helping them navigate it.
Excellent. Well said. Well, Patrick, thank you again. And yeah, always looking forward to the next opportunity to collaborate together. Thank you.
Definitely looking forward to it. Thanks a lot.